Too much inventory has a direct impact on profitability.
However, there are also many ways in which functions within the business can have a direct impact on profitability. But like all activities in a business, if they are not measured, one cannot know what their performance is, whether it is good or bad.
This is why it is important to measure logistics costs, inventory holding costs, and ordering costs. All of these can improve the profitability of a company.
Transportation costs account for roughly 50% of the total logistics costs, and therefore provide the biggest opportunity for improvement. By focusing on each element of cost, savings can be identified.
The same applies to inventory holding costs and ordering costs.
Cost cuttings can be found in the cost of capital, warehouse and handling costs, and the cost associated with risk.
A primary risk in holding costs is the possibility of obsolescence and excessive inventory. Monitoring the life cycle of a product and holding the right levels of inventory according to this can have a significant impact on the cost of holding inventory.
For example, if a business knows that a product is going to be replaced with a new version, they will not manufacture or order components needed for the old version. They will rather run down the stock levels of the soon-to-be obsolete finished item and start manufacturing the new version.
Ordering costs include costs to place an order, costs to transport the product from the supplier, costs to receive the order, and costs to place the order in storage. Each part of ordering cost presents an opportunity for reduction.
Receiving of inventory is the start of inventory storage costs. If mistakes are made in the receiving process, the cost implications are added to the product at every further step in the life cycle of that inventory item.
Purchasing can impact the profitability by implementing performance measurements and holding suppliers accountable for the delivery times that they promise, thereby reducing lead times. Whilst it is never a good idea to simply purchase large quantities of a product because a discount is offered, performing a cost analysis to determine the economic order quantity, EOQ, and obtaining volume discounts from suppliers based on this is definitely worth implementing.
A concept we need to understand when discussing inventory valuation is cost of goods sold, or COGS. COGS includes the cost of production, raw materials, direct labor, consumables, and PPE. If we were to write off damaged or obsolete inventory, or if inventory went missing through theft or careless document control, this would have to be added to the COGS. This, of course, reduces the profitability of the business.
COGS are recorded on the income statement, which in turn is reflected on the balance sheet as retained earnings or loss. An important point to note is that shareholders use a balance sheet to determine whether their investments will give them a good return on their investment.
Inventory valuation is important because it affects the COGS, which is a significant amount reported on the company's income statement. Inventory is also an important component of a company's current assets and working capital.
Working capital is calculated by taking the total sum of the current assets and deducting the current liabilities. Working capital is also reflected in the cash flow statements, which are typically prepared every month.
A different cash flow calculation used by businesses is the cash flow budget. This provides a forecast of inflows versus outflows and is used to manage cash on a much more frequent basis, sometimes even daily.
Break-even point is probably one of the most important measurements in business. This is used to determine the point at which the business starts to make a profit.
Other financial ratios used to manage the profitability of a business include return on assets, gross profit rate, and return on sales.
Return on assets, ROA, is an indicator of how profitable a company is in relation to its total assets. In other words, does the amount of money spent on assets reap the required profitability?
Gross profit is equal to sales less cost of sales, or COGS. The gross profit rate determines the ratio of gross profit to sales.
Return on sale is the percentage of income derived from sales.
Over and above all of these measurements are liquidity ratios such as the current ratio, the asset test ratio, the cash ratio, and the working capital ratio. Ultimately, what all of these measurements seek to do is to provide the business with a means to monitor and manage the effectiveness of their inventory and to ensure that no wastage occurs.